Hello, everybody, and thank you for taking the time to be here. My name is Cole Jager. I'm a wealth manager at Jager Wealth Management. We're a family financial advisory firm based in New Jersey. We've been helping individuals and businesses with tax planning and retirement plan design for over 20 years. And the goal of today is to give you all practical tax strategies you can apply to your businesses with updated 2026 rules and regulations for the new year. Whether you're looking into starting a business or you already run an established one, or you just want to learn more about tax savings, I think there'll be something in here for everybody. First, we'll talk about entity structures, then deductions, then business retirement plans, so 401k, IRA, cash balance plan. First, entity legal structures and tax classifications. So there's a difference between the legal structure of your business and the tax classification, and I hope that this slide can help clear that up. Sole proprietorships are entities that are taxed as sole proprietorships, meaning your business income is your personal income, your expenses are your personal expenses. There's no differentiation between you and the business for tax purposes. Partnerships and S-corps are taxed similarly to sole proprietorships. They are all considered pass-through entities, which means that the business profits and losses pass through to the owners and are taxed at their ordinary income rate. So if you're a LLC, you are by default taxed as a sole proprietorship. If you're a multi-member LLC, you are by default taxed as a partnership. But both LLC types can elect to be taxed as an S Corp or a C Corp, and there may be some advantages to both that we'll get into. Corporations are taxed as C Corps by default, though they can elect to be S Corps if eligible. C Corps are really if you want to have shareholders and you're trying to raise capital, they're taxed at the corporate tax rate of 21%, and shareholders are taxed again on their personal taxes on their dividends. So in a way, they're double taxed. We're going to be focusing much more on these pass-through businesses here, as that's most small businesses, and it's good to know the difference. Here is an area where the difference between these matters the most, and this is your FICA or payroll taxes. These fund Social Security and Medicare. So typically they're split between the employee and the employer, and each pays 7.65% on the employee's earned income. However, if you're taxed as a sole proprietorship or a partnership, you are the employer and the employee. And so you're paying the combined self-employment tax. What you can do here is you can deduct 50% of that self-employment tax on your 1040 above the line. If you're taxed as an S Corp, then you pay that 15% only on your salary and not on your business profits. So let's say your business makes $150,000 in profits, your salary is $80K, you're only paying taxes on that $80K. So some LLCs will elect to be taxed as S Corps for this reason, and some sole proprietors will become single member LLCs so they can then get taxed as S Corps. But choosing one designation or business entity over the other has factors that go beyond just tax savings. So while I want to bring these to your attention, the decision to change tax structures or classifications is not something I'm advising on, but it's a bigger decision to have a conversation with your accountant about. Business deductions. So the QBI deduction is for qualified business income. And if you're a pass-through business, so a sole proprietor, partnership, or S Corp, and your business income is below the number on the right, you should be claiming the QBI deduction on your tax return. Or I guess this isn't your business income, it's your income overall, whether you're filing joint or single. If you are between the two numbers, this phases out. If you're below the number on the left, you get the full 20% deduction. So if that does apply to you, that's very important to know, and not everybody knows about this one. The SALT cap. So no one likes paying state and local taxes on the same dollars that they're already paying federal taxes on. So thankfully, you can deduct up to $10K on your federal taxes for what you pay in state and local taxes. The problem is that it only applies to $10K. That's the SALT cap. Good news is most states, including New York and New Jersey and Connecticut, have a SALT cap workaround for pass-through businesses. You can elect to pay the full amount in state taxes, and then you can write off the rest on your federal taxes. This applies to partnerships and S corps. Unfortunately, it doesn't apply to sole proprietorships because you have to pay those taxes at the entity level. Write-offs. So what are the expenses that you're allowed to write off your taxes? Marketing and advertising costs, travel for business. So you can write off gas, tolls, parking, hotels, and 50% of meals. Supplies and equipment that you buy for your job, like computers, software, office furniture. Professional services related to your business, like lawyers, accountants, consultants. Health insurance premiums. If you're a pass-through business, you do not have to pay taxes on your health insurance premiums for you, your spouse, dependents, or kids under 26. Home office deduction. Definitely a good one to know about if you work from home. You can deduct the portion of your rent representing the square foot of office space in your apartment. So if your apartment is 2,000 square feet and your office was 500 square feet, which would be a big office, but it works for the example, you could deduct 25% of your rent. Startup costs up to $50K. So if you're beginning a business, you can deduct the costs of research, travel, legal fees, licensing, any expenses related to the startup of that business. And it must be before the business has operated. You can deduct $5K in the first year, and then the rest up to $50K can be amortized over the next 15 years in deductions. So business retirement plans, 401Ks, SEP IRAs, I'm sure you've heard of some of these. Knowing all the options available to you and how to leverage them is an extremely overlooked piece of tax planning. These plans have two main purposes in tax planning. They can reduce taxable business income in the current year by taking salary and business profits and putting them into tax advantage retirement accounts for you and your employees. So the second purpose is the tax advantaged savings. Let's quickly overview the two types of retirement accounts that you can contribute to. In a traditional account, you put money in and you don't pay taxes on it until it's withdrawn. This is great if you're looking to reduce taxes in the current year and you want to defer taxes until retirement where you're likely to be in a lower tax bracket. You'll pay taxes on both the growth and principal at your ordinary income rate when withdrawn. So if your income was $100,000 and you contributed, say, $23,000 to your 401k that year, you only pay taxes on $77,000 of your income. And this is one of the main ideas that we'll focus on in a moment. And in a Roth account, you'll pay taxes before the money goes into your account. And then you don't pay any taxes when you withdraw it. So all the growth is tax-free, which makes it great for long-term growth investing. These accounts do penalize you if you withdraw before 59.5, but that only makes sense as they are retirement accounts. Two key components to business retirement plans, especially 401ks, are your salary deferral and profit sharing. So these apply to both you and your employees. Maybe you're a W-2 employee who's unfamiliar with how your plan works. This also will apply to you. So salary deferral, this is where the employee elects to defer a portion of their salary to their tax advantage retirement account, and the employer will often contribute a match. Profit sharing, this is a contribution made by the employer to the employee's retirement account. It's an additional percentage of the employee's salary. So 401ks. This is the most popular type of retirement plan, and that's because it offers a lot of flexibility and it can work for any company, whether you have 2 employees or 200,000 employees. You and your employees can make contributions up to an annual limit of $72,000 or $80,000 if you're 50 or older. And by the way, there are also solo 401k plans that we'll get to, so this applies to you even if you have a solo business. The salary deferral in a 401k is a max of $24,500. Those are the updated 2026 numbers. Catch-up is $8,000. Super catch-up, if you're between 60 and 63, is $11,250, and the employer can match on top of that. These can be made as Roth or traditional contributions, and you could also set up a plan to have profit sharing of up to 25%. Again, 401k plans are flexible, so you can choose to match for your employees. You can choose to do profit sharing, both or neither. Most plans have either one or the other, but you can customize to meet your specific business needs. If your business has irregular income, you can do a discretionary match or flexible profit sharing. So you'll only contribute what you can afford to in a given year. Another great thing is that there are no income limitations for contributing to these accounts, unlike with IRAs. So no matter how much you make, these contribution limits are the same. Let's take a look at an example of how this plays out. This is Wendy Workington. She is an employee and she makes $100,000 a year. Wendy can defer $24,000 of her salary to her 401k. If her contribution was all pre-tax or traditional, her taxable income for the year would be reduced by that amount. In addition, with her employer match and profit sharing, she is saving $32,000 a year and paying $24,000 less in taxes. She's a happy employee. Much of this also applies to you, the employer, Bob Boss in this case. He can also defer $24,500 from his salary. Bob is also eligible because he is 60 for the super catch-up. But this is a new for 2026 rule. Since Bob makes over $150,000 as a salary, he can only make this catch-up contribution to a Roth account. That was not true last year, but it is true this year, unfortunately. Bob has also given himself additional savings with his profit sharing and his other match. So he's saving $55,000 a year, and his taxable income is down by that salary deferral amount. After-tax contributions. This is actually another way to contribute to a 401k and help you get up to your annual limit that's not as well known. After-tax contributions can even present a nice backdoor Roth opportunity for anyone looking to juice their Roth. So how this works is you contribute any amount you want up to your annual limit in after-tax dollars. So if you only hit $40,000 of contributions that year, you can fill up the rest of your annual contributions up to that limit in after-tax dollars. And then this has to be done quickly. You can roll over that money to your Roth 401k, and that's the backdoor Roth opportunity. It's very simple, but it comes in handy if you really like those Roth savings. Many plans don't allow for these additional after-tax contributions, and that's why when you're setting up your plan, it's really important to be careful about who is hosting your plan. And it's one of the reasons why we don't always recommend off-the-shelf plans, because they may not let you customize that deeply. Safe Harbor 401k. So this is another way to help you hit that annual limit more easily. Normally, if you're doing profit sharing, the amount that you give yourself is required to be the same amount you give your employees. So maybe you'd like to put an additional 20% in profit sharing, but you can only give your employees 5%. Additionally, if you have a low participation rate among your employees, you may be limited in how much of your salary you can defer, but not with the safe harbor. That's a way to get around those two. It's a very common option. The employer just needs to offer a 4% elective match or a 3% non-elective match to all their employees. And if you meet this, you don't have to meet non-discrimination laws, which is nice, and you can contribute much higher salary deferral and profit sharing amounts to yourself or other high-ranking employees. Back to our example, Bob is now able to increase his profit sharing amount as much as he wants, and then he can hit that 401k annual contribution limit. Solo 401k, pretty much the same, but for self-employed individuals. It works really well with 1099 employees, freelance workers like real estate agents, mortgage brokers, etc. There's no non-discrimination testing, which is nice. And it's easier to max out with profit sharing since you're just assigning yourself that percentage. Here's an example of this in action and how it reduces personal and business income. And this is also just mostly how it works for other 401ks, just to show you how it's divided between business and personal expenses. So if your business made $200,000 and you pay yourself a $100,000 salary, a salary deferral will reduce your salary, and the match and profit sharing contributions reduce that business profit. So your taxes are reduced across the board. Solo plans are also great because if you're paying self-employment tax of 15.3%, that FICA tax we talked about earlier, on top of your normal income tax, then reducing your taxable income can be even more important if you're self-employed. SEP IRA. This is mainly for people who want a quick, easy, inexpensive retirement plan for their employees with little maintenance. It works very well for small teams and is a decent option for self-employed people as well. With these plans, only the employer can contribute, which is done as a percentage of the employee's salary. So kind of like profit sharing. It must also be the same percentage for all employees, so it doesn't offer the flexibility of a 401k, and you also can't make Roth contributions to a SEP IRA. That also goes for a simple IRA, which is another plan for those who want something easy, cheap, and low maintenance. Unlike a SEP IRA, this plan only offers salary deferral, so the employee contributes and not the employer. And the limits are less than that of a 401k, just 17K and a 4K catch-up. Additionally, the two employer match options are fixed for you, so it doesn't allow for the flexibility of 401k in this way, but it is easier to operate if that's something that you're looking for. So cash balance plan. This is a much less well-known option than the ones we mentioned before, but it's one we've implemented for several clients and they really love it. It's great for high-earning employers who might want to go beyond the $72,000 or $80,000 a year limit for themselves and really max out their savings and reduce taxable income. It's a different type of plan called a defined benefit plan. What you need to know is that a future amount is guaranteed for each employee in the plan at retirement, and there's basically annual checkpoints along the way to make sure they get there. That's why I included this little mountain image to help you visualize that. That's how I like to think about it. So here is what the cash balance plan looks like in action. Wendy's retirement target is set at $300,000. She gets 5% pay credit, 5% interest credit a year. And Bob Boss, his salary, which is $400,000 a year, his annual contribution to his account is set at 40%. So he's contributing $160,000 a year to his account. And yes, it can be that high and even higher depending on what your income is. This reduces his taxable income by a substantial amount. And he can combine that with contributions he's making to his employees and shift a lot of business profits away from taxation. Yet another benefit to cash balance plans is that they can be built on top of a 401k. So you can make contributions to both. And when you combine these two in a well-designed plan, you can substantially reduce taxes and really save a lot. This is also a great option in light of the new 2026 rule change to 401k plans where the catch-up contribution now has to be made in Roth. So the cash balance plan, you can contribute more traditional savings. So here is a chart that could be helpful for you to compare the plans. I'll send this out after the call so you can all take a longer look. I'm sure you're wondering about the costs of setting up a plan, and they can certainly vary, but the good news is that these costs can be offset by tax credits with the Secure Act. So if you are starting a new plan, you can get $5,000 a year each year in the first 3 years just for starting the new plan, and an additional $500 in those first years if you have auto enrollment on. So that's over $16,000 in tax credits just for starting the plan. So this can really offset the cost of beginning one. And on top of that, there's the employer contribution tax credit for the first 5 years. Companies with less than 100 employees are eligible for employees making under 100K. Any contributions you make to them up to a $1,000 cap are given as a tax credit back to the business. And this phases out over the first 5 years, like you can see in this chart. So you're essentially getting some of your contributions back during those first 5 years. And if you happen to have a plan in place but are considering switching providers to a new plan, you can still take advantage of these tax credits so long as the plan is considered new by the IRS. So I'm looking forward to answering all the questions you might have and getting into the specifics of your business and how some of these strategies could help. Retirement plans and business plans overall are by no means one size fits all. So we custom tailor each plan we design to the business we're working with. Ron and I would love to be part of the process of helping you structure your plan in a way that benefits you and your employees. So in my follow-up email, there's a link to schedule a 30-minute meeting with me, or you can call us and our assistant will help you book a time. The meeting's totally complimentary, just so we can get to know your situation and help you a little bit more one-on-one. I really look forward to talking to all of you soon, and thank you so much for listening.